Hi, this is Linda Eedes, and I'm going to be giving you an update on the RECM Balanced Fund, which is our Regulation 28 Balanced Fund. Looking at the performance of the fund year to date, and we're sitting now towards the end of May, the performance of the fund is up about 13%, and that's against the average fund in the same universe, which is up roughly 3%. So a nice recovery coming through this year, but of course a lot of ground to make up looking at the performance going a bit further back. But nice to see that some of the resource stocks which actually caused that weakness have come through strongly, and we still think that they are significant opportunities for the fund, and thus you'll still see them being significant positions in the fund at the moment. So the contributors to that performance were, as I mentioned, the resource stocks, as well as some of the local stocks such as Standard Bank, which saw a little bit of a rebound after sort of coming down quite significantly following the whole Nenegate saga. And on the global side, stocks such as our Russian companies, Sberbank, as well as Gazprom, which is of course the energy producer in Russia, coming through quite strongly year to date as well. On the other hand, areas like the financial sector globally did come under a little bit of pressure, and that's also on the back of rising interest rates and fears with regards to default on the debt side. And we've taken the advantage to increase our financial sector exposure by, for instance, increasing our allocation to businesses like Berkshire Hathaway, which does have a lot of underlying exposure to the financial sector in the US in particular. Looking at the composition of the portfolio and discussing sort of some of the movements year to date, the global part of the portfolio has actually been brought back a little bit. From 22% to now sitting at about 18% if you look at cash and equity together. And that is primarily on the back of the Rand's depreciation. So if you look at the Rand in terms of inflation differentials, it's significantly undervalued. Put another way, the dollar is inordinately strong, and we thought we would take advantage of that by bringing some of that back to South Africa. We've also increased our bond exposure locally, and that's because of the yields coming up a bit, remembering that your return from bonds is really mostly made up of the yield you get when you invest in them. We're getting slightly in excess of a 3% real return from bonds now, which we believe is an appropriate return for the risk of lending, of course, to the South African government, but a small exposure there of 3%. Looking at other changes to the portfolio, we've bought in a few new stocks. Globally, that includes Russian food retailer X5 Retail, Chinese e-commerce business JD.com, and the engine manufacturer Rolls-Royce in the UK. Locally, we've taken advantage of the cyclical lows in businesses like Raubex and Invicta, both good businesses where the market is being a little bit short-sighted about their prospects. And we think that looking through the cycle, today's prices represent a good opportunity. So looking at the overall structure of the portfolio, we still have quite a bit of cash in the portfolio as well. You can see that the local cash component is about 43%. And that does give us the opportunity to take advantage of market volatility as quality businesses do become cheap. Looking at the top 10 of the equity positions, which will give you an idea of sort of the flavor of the portfolio on the equity side, you can see that there's still quite a few resource stocks which dominate there. In particular, you've got your platinum producers, Impala Platinum, as well as Anglo Platinum, Anglo American, and BHP Billiton. Remembering that BHP Billiton was actually a new position in the portfolio towards the end of last year. We had a strategy of switching some of our resources exposure into higher quality businesses, and BHP Billiton is the highest quality resource company in the portfolio, but only really became cheap enough to add significantly to during the last quarter of last year. And then lastly, Sasol as well, which on the back of energy prices also represents an opportunity. We also have other exposure outside of the resources segment. So looking at sort of some of the industrial exposure, you've got HCI, which is Hoskin Consolidated Investments. That gives the portfolio quite significant exposure to gaming and leisure, in particular through their stake in Tsogo, as well as looking at the industrial exposure, which you gain through the vehicle RECM and Calibre, which is of course our preference share, which is a joint venture between ourselves and Calibre. That has got a really nice mix of underlying businesses trading at a significant discount to their fundamental value, and with the advantage of permanent capital. So that allows us to take advantage of some unlisted businesses and smaller businesses, which if you didn't have permanent capital would be difficult to access. Then you can see that there is some banking exposure which has come through there, in particular Standard Bank and Nedbank. Of course, financial stocks have come under a bit of pressure over the last year, as certainly the interest rate cycle starts to come through, and also on the back of the woes with regards to Nenegate and the likes. So we've got significant exposure both to Standard Bank and Nedbank, to the extent that they now feature in our top 10. But those we will build as the cycle works through, so sort of an initial position there really. And then lastly, we have exposure to Blue Label Telecoms. This is a business that's done very well year to date. It's actually up more than 30%. So we have been trimming back this exposure, and you may well see it actually dropping out of the top 10 going forward. They distribute secure electronic tokens of value, in particular prepaid airtime and electricity in South Africa. And they also have transactional services across quite a vast distribution network in South Africa. They generate excellent free cash flow, and they have very little capex. And they're also an example of a company which has a market cap of 6 billion. So it's a good example of an investment opportunity which is really only available to smaller asset managers like RECM, who have a wide opportunity set. So looking at the portfolio as a whole, what you have is a nice diversified opportunity set amongst the equity side of the portfolio, both locally and globally, as well as a sizable cash component which we can put to use when opportunities do become available. Thank you.